Let's talk about smaller strategies for a second. Traders often check key statistics for various strategies, including average P&L, win rate, and losses. However, one important metric that traders often pay less attention to is P&L volatility. What happens if we try to take less risk? Are we actually increasing the volatility of the trade? Meaning, by thinking we're taking less risk, are we actually taking maybe even more risk than we realize? Not P&L risk, but volatility risk, meaning that it may be very difficult to make money trying to take less risk. A lot of times,
I think it's going to show that result easily. But go ahead.
Yeah, so do I. I mean, a lot of times when we take a little bit more risk, it's a little easier to make money. We take less risk, it's a lot harder, of course, and it should be that way. Let's go to the next slide. First, we're going to examine an example comparing the performance of 10 delta strangles and 20 delta strangles with 45 days to go to expiration. Let's take a look. We're going to manage both at 21 days. Let's go to the next slide, John. The results are consistent with expectations. The smaller delta strangles, 10, yielded lower P&L but a higher win rate, and smaller losses and lower P&L volatility. Because you're further out of the money. So you make less money, you win more times, you have a smaller largest loss, and you have a little bit less P&L volatility because it's further out of the money. It all makes sense. However, if we look at the P&L volatility as a percentage of the final credit, the smaller delta would actually be more volatile. This makes sense given how much cheaper premium we collected from the smaller delta strangles. So we look at volatility as a percent of credit here. This is just a naked strangle. You can see when you sell the smaller strangles, your P&L volatility is actually, almost 50% more. So you make a little less money, you have a higher win rate, you have a lower largest loss, you have less P&L in dollar volatility, less, but in actual as a percent of the credit, it's greater. All right, that's interesting. Let's go next slide. So the result implies that a cheaper or safer strategy doesn't necessarily translate to lower P&L volatility or lower portfolio volatility. So let's talk about risk define next. So we're going to look at spreads with 30 delta short strikes, and then wings at 25, 15, and 5 deltas. And same thing, exit all the positions at 21 DT. So a very conservative approach. Let's go to the next slide. And here you can see the riskier the strategy, the wider the wings, the higher the average P&L and the win rate. That's perfect. However, the volatility as a percentage of P&L was actually lower. So when you look at the first slide, short the 30 delta, long the 25 delta wings, the wing width was narrow. Average P&L was really small. The win rate was obviously going to be the lowest, but the P&L volatility in this case was also the lowest. When you go the widest, the P&L volatility was, as a percent of the credit received, was the highest. All the other numbers kind of line up. So again, just making sense, just all the numbers play out exactly the way you would thought they would. If we examine their CVAR, conditional value at risk, the results are consistent with our findings. Perceived less risky put spreads with the tighter wings have the potential to generate greater position volatility. This strongly indicates that making single positions reasonably larger is not a bad idea to reduce portfolio risk. When you look in this case, again, you can take a look. These are the short put spreads. This is the P&L volatility, and this is and again, the CVAR as well, the conditional value at risk. Okay, nothing on this slide would probably surprise you. We just don't look at the volatility as a percent of credit very often. It's just not the way we look at things. Just a different approach.
The dollar amount's going to be less, but the percentage is going to be greater. It's hard to look at things in percentages sometimes because they're not misleading. They could just be so great, and yet the P&L number is small.
Some of the takeaways here: position volatility is an important metric to consider when measuring portfolio performance. Small or perceived less risky strategies can sometimes generate higher volatility as a percentage of their position size. Risk-defined positions with extremely tight wings can cause disproportionately high volatility as a percent of the capital used, leading to unnecessary risk. Interesting.